we are going to look at closing entries in this lesson, and closing entries are the last step in the accounting cycle. So we have made our way through the accounting cycle. So just to review with you, the steps of the accounting cycle are as follows. Step 1 is to analyze source documents and record business transactions in a journal. Step 2 is to post journal entries to the accounts in the ledger. Step 3, prepare a trial balance. Step 4, gather adjustment data and record the adjusting entries on a worksheet. Step 5, complete the worksheet. Step 6, journalize and post the adjusting entries. Step 7, prepare financial statements. Step 8, journalize and post the closing entries, which we are going to learn how to do now. And step 9 is prepare a post-closing trial balance. So the purpose of closing entries is to close or zero out all of our revenue, expense, and drawing accounts. So if you remember, we've talked before that revenues and expenses must be recognized in the fiscal period in which they are incurred, and drawing as well, which we haven't really spent a lot of time talking about it, but drawing is only shown in the fiscal period in which it's incurred. And when a new fiscal period starts, we start again from zero with those accounts. Revenue, expense, and drawing accounts are what are known as temporary or nominal accounts. Your assets, liabilities, and capital are known as permanent accounts. So let's review the accounting equation. Let's adjust this. So if you recall, the accounting equation is assets equals liabilities plus owner's equity. And as we learned, owner's equity is made up of capital, drawing, revenue, and expenses. Okay? And we know that capital is the owner's stake in the company. Drawing is money that the owner spends, so that's going to bring the capital, the owner's stake, down. Revenue is money that the company earns, so that's going to bring the owner's stake, the capital, up. And expenses are incurred for running business, and that's going to bring the owner's stake down, the capital down. So when we talk about closing the temporary accounts, drawing, revenue, and expenses, we're simply taking these accounts and putting them into the capital account. So drawing is going to go into the capital account, revenue is going to go into the capital account, expenses go into the capital account. It's important to know that owner's equity can also be referred to as capital, and that's where we see in the new equation, which is not new, it just looks a little different, of assets equals liabilities plus capital. That's the equation once all the closing entries have been made. So there are some changes that we're going to make, and we all know about my rules, right? So we know that we can never, ever, ever credit an expense account, right? We can never, ever, ever credit a drawing account, and we can never, ever, ever debit a revenue account. Well, I told you that there was going to come a time where that was not going to be true, and this is the time when we're closing the temporary accounts. So the first step in the closing process is to close the revenue accounts. So think about your revenue T account. It has a normal balance on the credit side, okay? So if I were to put in a balance over here in the amount of $1,600, in order to close that, in order to make that zero out, I would then have to debit that account $1,600. Okay? And when I debit that account $1,600, we know the account is now zeroed out. So once that happens, I can then just put my little line in here, and I can say that my account is now at zero. Okay, and so what I'm going to do is I'm going to color my closing entries a different color so we know. All right, so now for every debit we know there's an equal credit. We know that revenue has a positive effect on the capital account. It has a positive effect on the owner's stake in the company. Okay, so we take that revenue and we're going to put it into the credit account, the capital account, by crediting it. So therefore, the closing entry for a revenue account is going to be a debit to revenue and a credit to capital. Now we have expense accounts. And if you recall, expense accounts have a normal balance of a debit. All right, so to close them, we would have to credit them. So let me go ahead and put in a expense here. And we got a debit of, let's just say, $500 in expenses. Okay, now in order to close this, in order to zero it out, I would have to credit it $500. And once I did that, this account, I could now put a zero balance in. And remember that zero, though, is going to be on the debit side because it's a normal balance of debit. Okay. And we know for every credit, there must be an equal debit. We know that expenses affect the owner's equity or the capital account in a negative fashion, and therefore there is our debit. We are debiting the capital account. We're saying the owner now has $500 less stake in their company. So the closing entry for expense accounts is going to be a debit to capital and a credit to all of the expense accounts. Now the last closing entry is to close the drawing account. So remember, drawing accounts have a normal balance of a debit. So if I go ahead and put in a debit balance, let's say $150, and we want to close it, we have to credit it. So we will then credit $150, and I will make that red so we know. And therefore our drawing account is now zeroed out, and again that zero is going to be on the debit side because that is the normal balance for drawing. And for every credit there is an equal debit, and we know that when the owner withdraws money from the company, they're essentially taking out their own stake in the company. So when we close the drawing account, we debit the capital account, therefore decreasing the owner's capital or stake in the company. So the closing entry for drawing accounts are a debit to capital and a credit to drawing. So here we see some sample journal entries of how these closing entries actually appear inside of the general journal, and you see that our revenue account is debited and it is closed into the capital account. The credit account is, the capital account is credited. So the revenue is increasing our capital account. And here we have all of our expenses, and all of our expenses are credited to close them out. And they are then closed into the capital account, and it's debiting the capital account by the total amount of our expenses. So they are decreasing the value in our capital account. And then we have our drawing, which to close, we credit it, and it's closed into the capital account. And we know that that is decreasing the value of our capital. So at this point, I want to practice actually going through the process of closing some accounts. I think that that will better illustrate for you what's happening. So if you could make sure you have the spreadsheet closing entries demo open, we're going to do one together and then you will do one on your own. Okay, so when you post or journalize closing entries, you always do it directly from the income statement. So what we have here is a snapshot of the income statement. We don't have the full income statement. This is the columns on the worksheet, all right? And we also have the information at the top there that Kay Dunn withdrew $4,000. Okay, so we're going to go ahead and close all of the temporary accounts. So we'll begin with closing the revenue account. So first thing, we put in the date. So this is for June 30. And since revenue accounts have a credit balance, to zero them out, we need to debit them. So we're going to say service revenue, a debit of $67.97. And then we're going to close that rental revenue at the same time. Okay, you don't do separate closing entries for each individual revenue and expense account. You do them all at once. Okay, and that is going to be for a debit of $35.76. The credit, we know, we talked about, is going to be the capital. We're taking the revenue and we're putting it into the capital account. Okay, we're increasing the capital account by the amount of our revenues earned. So the capital account here would be K done capital, and it's going to be the total of these two. So I'm just going to use my formulas, add those two up, and it's a total of $10,373. So our revenue accounts are now closed. All right, let's take a look at the expense accounts. We have 1, 2, 3, 4 here. All right, so this is on the 30th again. So expense accounts have debit balances as we see here on the income statement. So to close them, to cancel them out, we need to credit them. And we know that we're going to put them into the capital account. Actually, it's going to bring the value of the capital account down because we're going to have to debit the capital account. So I'll go ahead and put that placeholder in, and then we will put the total in after we have recorded all of the expenses. So the first one we have is rent expense, and we're going to credit that in the amount of $2,800. And then we have wages expense in the amount of $1,854. Utilities expense, $465. And lastly, miscellaneous expense. $59. Okay, so all of those are being credited. They are all now going to be zeroed out, and for every credit there's an equal debit, right? So we're going to debit capital. Remember, a debit to capital brings the value of the capital account down, just as expenses bring the value of the capital account down. And I'm actually going to just use my auto sum here and sum those up. And that is $5,178. I spell capital right. All right, and the last account we have to plug in is the drawing. That's the last account we have to close. Drawing has a debit balance, so to close it, we're going to credit it. So we know that we're going to debit capital. We're going to bring down the value of capital by the amount of our drawing. So it's going to be $4,000. And then we're going to credit K done drawing $4,000. And those are your closing entries. So interestingly enough, and I want to point this out, you know, we closed expenses into capital and we closed revenue into capital. And we know that this company, if we look at these two numbers here, the total of our revenue is greater than the total of our expenses. So that means that we have a net income. And if you actually did the math, you would find the difference between this credit to capital and this debit is the total of the net income. So you're essentially putting that net income into your capital. You're accounting for it when you're closing your expenses and closing your revenue accounts. That's an important piece to kind of make note of. All right, now what I would like you to do is the practice, which is the same thing. We just have some different numbers. Be sure to submit your work when you are done.